Hello, everybody. Welcome. This is Bennett Tchaikovsky, and we're now going to kind of dive into some fun topics about issuing a bond in between interest dates, as well as bond redemptions. And this is going to be new beyond what I would have been teaching in financial or a financial accounting class. So my disclaimer and copyright notice: the information and opinions of this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky, all rights reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. Author does not claim any right to the copyright that I'm referencing in those parties. Okay, so we're going to go through bond redemptions. We're not going to sing a redemption song, but we all know what that is. Very, very important if we look at YouTube. And it's actually an absolutely beautiful song. So I'm just going to play just like that a little bit so you know. But if you've ever seen the movie I Am Legend with Will Smith, it's used in that as well. Okay. So when it comes to bond redemption, this occurs when a company retires or pays off its bonds prior to maturity. The company pays bondholders redemption price plus any kind of accrued interest. Gain or loss may result from the redemption. So the way we're going to handle redemptions is we're going to identify what percentage of the bonds are actually being redeemed. We're going to then split off the bonds into the redeemed portion and the unredeemed portion, meaning that if we have a $20 million bond and we're redeeming 5 million of it, we're going to have to basically split off any kind of a discount or premium. So what we want to go through and we want to amortize that bond up to the redemption date, and then we're going to go ahead and record the journal entry. Now, the other thing I'm kind of throwing in here, because I've got a crazy question, but we're going to do what, because I think it's the best way to learn intermediate accounting, is when we have bonds issued in between interest dates. When a bond is issued in between interest dates, the buyer is going to be paying the seller the interest that has already been accrued from the last interest date to the date of issue. On the next interest payment date, the buyer is going to receive the full interest payment. This is essentially means that the buyer is going to be get back the interest they paid up front. Now, the one thing I also want you to be really careful about is when this happens, if there is a premium or discount situation, which there probably will be, you have to make sure that your amortization period for that premium or discount is going to be basically changed accordingly. And so, again, I would also, for the journal entry, I would also want you to kind of basically keep the repayment of interest kind of separate from the normal bond issuance. So let's go ahead and just jump right in. Sounds like a plan. So Blofeld, wonder where that's coming from. Issued bonds on 4/1/20, 4/20. I'm just kidding. There's no we actually a little bit diet, a heroin plan. I don't know. Issue bonds with a face value of $20 million at 103 plus accrued interest. The bonds were dated 1/1/20. The stated interest rate on the bonds is 8%, and the bonds pay interest semi-annually on June 30th and December 31st. Any premium or discount is amortized straight line. The term on the bonds is 12 years. So here we're going to go. Let's go ahead and have some. So the first thing we want to go through and do is let's kind of look at like what's happening on 4/1/20. And let's remember our friends. And our friends right over here are going to basically be, I sound like almost famous at the record store. This means assets equals liability plus owner's equity, expenses, revenues, debit, credit. Okay. And when you see something at 103, what exactly does this mean? It basically means that the proceeds were 103%. If it was at 100, it would just be issued at face value. But if it's 103, it's basically going to be at 103% of the total amount. So right over here is that we've got, okay, we basically are getting cash So the amount of cash we're going to receive is going to be 20 million times 1.03 or 20 million 600,000. Okay. And this is just, we'll come this down to be normal. Okay. So the cash being basically the cash coming around. Okay, so right over here on 4/1/20, I'm receiving cash of 20,600,000. So this is basically bond payable face 103 proceeds. Okay, now what we always want to remember is that we are always going to be crediting the bond payable for the face amount. Okay, so right over here, this is going to basically be at 20 million. Because this amount is greater, the cash received is greater than the face amount, the bond will be issued at basically be a premium on bonds payable. Okay. All right, so right over here, this is going to be, and we're not quite done yet, but I wanted to kind of separate this out first before we kind of go through and talk about the rest. Now, I'm issuing bonds with a face value of 20 million at 103, but I'm not doing this on 1/1/20. I'm doing it on 4/1/20. So this is basically, and it's paying interest every 6 months. So this is literally like right in between the payments. What I need to figure out is like, okay, how much interest is being paid on these bonds? Well, if I look at this here, I take to figure out the amount of cash that's being paid for interest. I'm going to take the face amount of the bond. I'm going to multiply this by the stated rate of interest. But remember, this is always going to be an annual rate. So the annual rate of interest is going to be 1.6 million. So therefore, if I multiply this by 6/12, okay, so basically over here, so the cash paid for interest every 6 months. Okay, so now this bondholder, right? So if we kind of think about this intuitively on 6/30/20, right? We know that, we're going to be recording interest expense. If you watch the other videos, we're going to have to be debiting the premium on bonds payable, and we're going to basically be crediting cash. And the amount of cash we're going to be crediting for here is going to be 800,000. Okay, so that's kind of what's happening now. This person who's coming in is like, wait a second, right? So you're getting the benefit of like, you don't, nothing is free. So when you see this here, right, it says basically face value 20 million, 103 plus accrued interest, right? So how much interest was accrued? Well, the cash paid for interest every 6 months is 800,000. And if we really look at this, we're going to basically multiply this by another 3/6, or basically January 1st through March 31st. Okay, so we're going to multiply this by 3/6. So what's happening here is this is going to be the cash, basically plus the cash, the accrued interest paid by the buyer. Okay, so in addition to this cash here, we're also getting another 400,000. But when I come over here and I do this, right, I'm going to be coming over here and crediting. Give me one moment. So over here, I've got this accrued interest paid by the buyer. And what I'm going to go ahead and do is I'm going to basically credit interest payable. Okay, and the reason why I'm going to basically do this is I'm going to have to go through and basically pay this interest when we come to that very first payment. Okay, so This is going to be to record bond issuance. Now, you will also sometimes see this as a credit to or to interest expense. And it's going to basically have the same effect because when we come here to 63020, the amount of like that interest expense is basically going to be, we're basically reducing it by this 400,000. Okay. Now, when it comes to this part over here, when we get to 63020, right? There's really kind of two things that are kind of happening over here, right? We have to pay the 800,000 bucks, but also what we're going to be doing simultaneously, right? So again, let's just take a step back for a second. I want to make sure that everybody kind of understands this, right? So Blofeld issued bonds with a face value of 20 million at 103 plus accrued interest. The bonds were dated 1/1/20. Stated interest rate of the bonds is 8%. Bonds pay interest semi-annually. Any premium or discount is amortized straight line. Term on the bonds is 12 years. Okay. So when we look at this, right, essentially we've got the cash coming in at 103, premium, always record bond payable the face amount. But at the same time, the buyer of these bonds is going to front us the interest because we're paying out 800 grand of cash. So that's why we had to go through and basically say, okay, the semi-annual interest payment's 800,000. But then over here, we've got the interest accrued, basically that's how much they're fronting us in terms of the cash. And I've seen that recorded also as interest expense. Now, when I come over here, I'm going to debit interest payable, and this interest payable amount is going to be for the 400,000. Now, here's where we get interesting. And remember, if we were not doing effective interest method, we're using straight line amortization. What exactly does that mean? Well, I want to start using my T accounts now. So I've got over here, I've got my bond payable, 20 million. And I also am going to have a premium on bond payable. And my premium on bond payable is going to be roughly 600,000. Now, on when we were doing our balance sheet, right? So we have basically non-current liabilities, basically as a 4/1/20, right? We're going to have current liabilities, which would be the interest payable. Interest payable would basically be that 400,000. For the non-current liabilities, you're going to have your bond payable of 20 million plus the premium on bond payable of 600,000, right? And if this is kind of, if I'm going too quick, please watch the other videos I made in the series. We're now dealing with, this is more, traditional intermediate accounting topics. Okay. So we've got a premium on bond payable. And so now basically my bond payable carrying value is going to be 20.6 million. Now, even though these bonds were dated 1/1/20, that's why we're dealing with that interest payable. And then we got cash, basically in our asset side, we got over here cash of roughly, 21 million. That's how everything balances. Now, as we've seen from my other examples, right? So if this is being paid out 12 years from now, it's 21. Okay, so this will be paid on December 31st, 2031. We're going to want this premium to go down over here to 0. Okay. And if we're doing this straight line, right, means that, oh, well, normally what I would do is I would say, okay, well, interest is being paid. Normally how I would amortize a premium is I would say, okay, you got the 600 grand straight line. You would then say, okay, how many times, how are we going through and doing this? Well, if it's 12 years and we're basically making two interest payments per year, there's basically be 24 payments of interest. So what I would traditionally do if it was not being issued in between interest dates, right? What I would kind of just go through and kind of say, well, I would add the 600,000. I'm going to divide it by the 24 payments. I'm going to get to 25 grand. However, we have a problem, right? Because this is not going to be really outstanding for 12 years from the date of issuance. It's really going to be 11 years and 9 months. Okay. So why is that? Well, the span of time is basically it's not going to be 12 years. It's 11 years and 9 months because they prepaid for 3 months of it. So in terms of months, this is going to be 11 years times 12 months in a year plus the 9 months, right? So we're going to be amortizing this a total of 141 months. So what we're going to do, it's always fun. What we're going to go ahead and do is say, well, instead of just dividing this amount by 24, I'm going to basically go over here and divide it by 141, which is really the 11 years plus 9 months. And so then my monthly amortization of the premium is going to be 4,255. So always fun here. But again, you want to kind of, I'm bringing up some kind of crazy concepts, and this is why we're here. Okay. So now, and remember, when we're amortizing a premium or discount straight line, as you can kind of see from the other ones before, we're really letting the carrying, when we're doing effective interest, we're letting the carrying value dictate the amount of interest it's fluctuating. But when we have along the lines of something where we have basically, if it is in fact um, if the amortization is basically straight line, we determine the amount of the discount basically first, and then the rest is going to be going to interest expense. So coming over here, right? So now the amount of my premium on bond payable, what I would say is, well, how many months of the premium should I be amortizing? Well, this is going to be 3 times 42.55, right? So 3 months times 42.55. Let me just make sure I'm rounding this right. So let's call this 4255. Okay. So then, because I'm going through and doing this, my interest expense by default is basically going to be, well, it's going to be the difference between the cash I'm paying, the premium, and then the interest payable here, right? Because remember, the interest expense is basically for that 3 months. So, always fun. If I had gone through and basically instead of using interest payable, if I just basically dumped the rest of it, my amount of my interest expense would end up being the same. So that is that is part one and part two. Isn't this exciting? I'm like, ooh, all right. Now prepare the journal entry to record the interest expense for the 6 months ended 12/31/20. Let's go ahead and do that one. Hopefully it'll be a little bit easier. Maybe not. I don't know. So on 12/31/20, right, we know that whenever we have a premium situation, the journal entry to record interest expense is generally going to be the same. Unless we have the crazy, record interest expense. And now over here, we've got interest expense. We've got our premium on bond payable. We have cash. So again, the cash is never going to change, but now my premium on bond payable, this is going to be 6 months times 42.55. Okay, so then my interest expense is going to be the difference between these two, or it's going to be 774,470. That's how I would go through and do this. And let's go ahead and just kind of on this premium side, let's just kind of say, all right, we did over here. This was on 630. Sorry, put it over here on 630. We debited the premium because remember, we want this premium to go down to 0. On 12/31, we're going through and debiting this over here for 25,530. And now let's go ahead and see what the next question awaits. Assume that 5 million of the bonds were retired on 6/30/22 for 5.1 million plus interest. And prepare the journal entry, record the bond retirement, as well as a journal entry for the interest expense for the retired bonds for the 6 months ended 6/30/22. Okay. So what I want to do before we even get there, right, is before we get into bond retirement, and I'm just going to copy this down over here so we get to, I'll kind of just bring this over here. So let's just bring this down here. Okay. So before we get to this part here, what I want to do first is I want to get my bond essentially, I want to basically get this premium up to date, right? So essentially what's happening, we'll call this 6/30/20, 12/31/20. We'll now do 6/30/21. I'm going to go solve some more room. Okay, so we got 12/31/21, and then we've got 6/30/22. Okay. So what exactly was happening over here? Well, we did the premium on bond payable, right? Because what I really want to do is before we redeem this bond, I want to try to figure out what's going on in terms of like what's the carrying value of this bond prior to the redemption. So coming over here, right, prior to any, we'll go ahead and do it like this. Basically, prior to, let's actually go ahead and do this first. So on 6/30/22, I would basically be debiting interest expense, premium on bond payable, and then cash. So the journal entry, because I'm using straight line amortization, is really going to go through over here and be exactly the same. Okay. Now, one of the things over here, which I kind of messed up on, is I would probably want to basically write this. Let's say basically bonds were retired on, let's make this a little bit easier on ourselves. Well, retired on 7/1/22 for 5.1 million. And we'll say after interest had been paid on 6/30/22. Okay. To make this a little bit easier on ourselves. And let's make it a little bit harder on ourselves too. So prepare the journal for the retired bond for the, let's do this for the bonds. So the journal entry for the interest expense for let's see here. Let's do 12/31/22. Okay. So right over here, basically, the first thing I wanted to go through and do is to say, okay, I've got this, my premium on bond payable up until the date of basically right over here. My premium on bond payable is roughly 485,115. Okay. Now, what I'm going to do to make my life a little bit easier, okay, is that I'm assuming that 5 million of the bonds are going to be retired. Okay, so what should I do? Well, right over here, I want to basically say, okay, I'm going to basically split up my bond payable to non-retired. Okay. And this is going to be 15 million. And then I want to do retired. Okay. Now, when it comes over here, and so this is really about 75% of the bonds payable, right? Or 5 million of the 20 million, right? So 5 of the 20, this is 25%. So what I want to go ahead and do is basically is with this premium on bond payable is to go through and to kind of say to ourselves like, well, my premium on bond payable basically at this point in time is I'm going to basically take so my non-retired, I'm going to take this times 75%. And then I'm going to have my retired premium on bond payable. This is going to be this amount here times 25%. I just want to make sure that these numbers add up, which I believe that they do. Okay. So now when I go through and I look at this, it's going to be a little bit easier for me to kind of go through and analyze with regards to the retirement. So again, what you want to do is record the interest up until like that date. And now we're going to basically go through and retire the bonds, right? So I retired the bonds 7/1/22. And the way I went through and retired these bonds, just give me a moment. Okay, everybody, we're back. Okay, so now what I'm going to do is, okay, so my cash is being credited. My cash is being credited for 5.1 million. Okay. And what I'm going to do now is I'm going to take these retired bonds off of the books. How am I going to go through and do that? I'm going to debit bonds payable for 5 million. And then I'm also going to basically get rid of the premium on bond payable related to the bonds I'm retiring. So my bonds payable right over here, it's going to be 5 million. I'm also going to be debiting premium on bonds payable because remember, I need to get these down to 0. So right over here, I've got this part over here, right? So as we look at this, and this is going to kind of go back to our days of selling equipment, right? When we sell equipment, the journal entry we always use is we're debiting cash, we're debiting accumulated depreciation, we're crediting equipment. And then if we sold it at a profit, we would have a gain on sale. And then the loss on sale if we have a loss. Now, I always use the gain or loss as what I call my plug or whatever I need to do to balance. So over here, right, I basically am going to have a gain on bond redemption. So my gain on bond redemption is going to be the amount of the basically of 21,279. And that's how we go through and look at this part of the question. So this is the fun of intermediate accounting. But when I'm redeeming this bond, I want to use the T accounts because this is going to make it a lot more simple for me. Okay. Now let's just keep on going. So when I get over here to 12/31/22, right? How much cash am I going to be paying out for interest? Well, I know that when I'm going through now on my non-retired bond payable, is that I'm going to basically say here is like, well, okay, I'm going to have interest expense. I'm also going to have a premium on bonds payable, and I'm going to be crediting cash. Now, am I going to be crediting cash for the 800,000? And the answer to that is no, right? My face value of my bonds, because I basically bought back 25% of them. So over here, I'm basically going to take right over here, basically over here, I've got, it was 8% interest. So right over here, basically I've got 8% interest. Remember, this is always going to be an annual rate. So my annual interest amount is basically going to be 1.2 million, but I'm paying this every 6 months. So I'm going to multiply this by 612, so 0.5. So the amount of cash that I'm paying out is going to be 600,000. Now, when it comes to the remaining, basically the remaining premium, there's a couple different ways I could go through and approach this. Probably the easiest way for me to do it is to say, well, 75% of 25,530, because this is the unredeemed portion of the bond. So I got 25,530 times 0.75. So my interest expense is now going to be 580,853. Why am I multiplying this amount by 0.75? It's because, well, it's probably the easiest way for me to kind of go through and look at it. Well, let's just go through and make sure that this thing actually works. So my non-retired premium on bond payable as of basically right over here, this is as of, 6/30/22, right? Was 363,836. If I'm going through and I'm basically paying it down by, or if I'm amortizing this by 19,147.50 as of December 31st, 22, let's kind of figure out when this bond is actually going to basically be due, right? So the bond had an original date of 1/1/20, but it was issued on 4/1/20. And the bond is basically going to be, it's a 12-year bond. So this is going to be 12 plus, let's see here, 365 times 10. So this is, or times 12. So this bond is basically going to be maturing on 12/29/31. So if I on 12/31/22, okay, if I went through and did this, right, just to kind of prove to myself that this actually can work, right? If I went through here and every single time I was basically using 19,147.50, and I add these up, I'm getting pretty close to this number right here. So this actually does work. So again, not that you have to go through and to do this, but again, it's just something that I want you to just to kind of prove to you that this thing actually works. And this is going to be over here to record interest expense. Welcome to intermediate accounting. I love on the old school Fantasy Island, like welcome to Fantasy Island. Okay, so that's enough of 1970s humor. But let me just pause real quick. Okay, I checked my AI solution and I think we may actually be good to go. So it's kind of exciting. So yeah, this is what we would go through and do when we have a bond being issued in between interest dates, and then we have a redemption song. This is what happens. So, in any event, I want to thank you for joining me on this way too long journey tonight. Thank you for watching. Please make sure to like and subscribe. Feel free to leave me a comment or email at ibc30tocpa@gmail.com, and I look forward to seeing you on the next video. Have a great day.